There's a secret reason why even millionaires can suddenly go broke. They own luxury homes, cars, and stocks, but when a crisis hits, they can't move a dollar. They're asset rich but cash poor. And that's why the most powerful word in wealth is not profit, it's liquidity. Because freedom isn't measured by what you own, but by how fast you can act. And when money stops flowing, even kings suffocate. So what does liquidity really mean? Simply put, it's how easily an asset can be converted into cash without losing its value. Cash itself is perfectly liquid. You can use it instantly. Stocks? They're fairly liquid. You can typically sell them within minutes on a trading day. But what about real estate? That's not liquid. Selling property takes time, paperwork, finding buyers. And often, you might have to cut the price to make a sale. You see, liquidity isn't glamorous, it's about readiness. Think of it as the oxygen of finance, invisible and often taken for granted, until suddenly you can't breathe. This brings us to a core idea. Liquidity is freedom. And what is freedom? It's having options. Liquidity gives you those options, the ability to pivot, to invest, to survive, or to seize an incredible opportunity when it appears. When a market crashes, those with liquidity are the ones buying assets at a discount, while others are forced to sell at a loss just to stay afloat. When life throws you a curveball, liquidity means you can adapt without panicking. The truly wealthy don't just collect assets. They strategically build liquidity buffers. They know that the most painful way to lose wealth is being forced to sell something valuable at the absolute worst time. Let me tell you the story of two friends, Kesser and Firin. Both were smart investors in property, but they had one key difference in their strategy. Kesser kept 20% of his entire portfolio in cash and short-term bonds, highly liquid assets. Firin, on the other hand, invested every single dollar he had into land, believing it was the ultimate store of value. Then, a global crisis hit. Property prices plummeted, and buyers disappeared overnight. Firin couldn't sell even one plot of land. His wealth was completely frozen. But Kesser, with her liquid reserves, was able to buy new prime land at half its previous price. She grew richer during the downturn, not because she was lucky, but because she understood that liquidity isn't just a safety net, it's a powerful offensive strategy. This principle doesn't just apply to individuals. It applies to entire economies. On a national scale, liquidity is what keeps the economic engine running. During a crisis, you'll hear about central banks injecting liquidity into the system. They do this so that banks can continue to lend, companies can pay their employees, and workers can keep earning and spending. When liquidity dries up, it's called a credit crunch, and that's when a recession truly begins. This is why policymakers often fear a credit crunch more than a stock market crash, because when money stops moving, confidence dies, and the entire system grinds to a halt. So let's bring this back to you. Your personal liquidity is your financial lifeline. Ask yourself a few honest questions. How many months could I survive if my income stopped today? How fast could I turn my assets into usable cash without taking a massive loss? Could I invest if the opportunity of a lifetime knocked on my door tomorrow? The answers to these questions determine your liquidity ratio, which is really your freedom score. The more liquid you are, the more choices you have, and perhaps more importantly, the calmer you'll feel. Liquidity is peace of mind that pays interest. One of the biggest traps people fall into is what I call dry wealth. They mistake ownership for security. They buy the big house, the fancy car, and tie up all their money in illiquid investments. Then, when an emergency strikes or a golden opportunity arises, they panic because they can't access their own money. This is the liquidity trap of success. Remember, real freedom isn't measured by the size of your assets, but by the speed of your access to them. It's the critical difference between being in control of your destiny and being dependent on market conditions you can control. So, how do you build true liquidity? It's simpler than you think. Start by keeping 3 to 12 months of your essential living expenses in an easily accessible form like a savings account. Then diversify your liquidity into tiers. Some should be instant, like cash. Some near instant, like high-quality bonds or money market funds. And some can be long-term, like real estate. During good times, when everyone is spending emotionally, resist the urge and keep some dry powder ready for the inevitable storm. And don't forget, your skills are an asset too. A marketable skill is perhaps the most liquid asset in the world because you can convert it into income almost anywhere, anytime. Building liquidity isn't being lazy with your money, it's demonstrating financial leadership. But let's be clear, liquidity is not about hoarding cash under your mattress and earning zero returns. It's about having control. It's the power to act decisively, without fear. It's about having access to opportunity capital, not just emergency panic money. This is precisely why the world's most sophisticated investors, family offices, and billionaires always hold a significant portion of their portfolio in liquid assets. They understand a fundamental truth. Motion creates money, but flexibility is what protects it. In the end, money that can't move is money that can't protect you. Liquidity is life. It is the flow that keeps systems, nations, and our personal dreams alive. Ultimately, freedom isn't built on how much you own. It's built on how fast you can move when the rest of the world stops. Liquidity is not wealth you count, it's wealth you can use. When others freeze, those with flow survive. Thanks for watching. If you found this valuable, please like, subscribe, and join us for the next episode. Stay curious and stay liquid.